Hey everybody, welcome back to another Business of Trucking video. Today we're going to talk about tax write-offs, okay? And they might be one of the most misrepresented or misunderstood things in all of small business, trucking, whatever you're involved in. And I want to explain to you today the math behind that and what it really means when you say that you're doing something for a tax write-off, okay? And I'm going to explain to you why not understanding this or having it represented to you properly can cost you thousands of dollars a year, and how you can keep a lot of that money in your pocket and still get the tax deduction. So stay tuned, and we're going to get into all that here today.
Yeah, DIY semi. If you have a truck problems, I feel bad for you, son. I got 99 problems, but a truck ain't one. Yeah, let's go. I got 99 problems, but a truck ain't one.
Now, firstly, I want to say that you should always consult a CPA, tax attorney, before making any decisions. This is just things that I do, my opinions. So always consult a professional, and hopefully that professional will have the reasoning and logic to steer you in the right direction. And I also want to say you should also take every legal and lawful tax deduction that's available to you. That makes sense. To seek them out, to seek out needless tax deductions, well, then you're just throwing money down the drain sometimes, and I'll explain that to you. And also, I really don't like the term tax write-off. What we should be saying is tax deduction, because that's what it is, okay? Like I said, saying write-off allows you to be just flippant and dismissive of things maybe we shouldn't do. So let's take a look at the math behind this, okay? Well, let's quickly cover here what a tax credit is, what depreciation is, then we'll get into tax deductions, okay? A tax credit is a dollar for dollar credit on your taxes, okay? There's not a lot of tax credits out there. You may take a child tax credit on your tax return, where that $1,000 credit saves you $1,000 in taxes. That's what a credit does. It's a dollar for dollar reduction in your taxes. So a $5,000 tax credit would save you $5,000 in taxes. That is not how a deduction works, however, but I wanted to point that out. Now, depreciation. Depreciation is how we account for larger assets, say a truck or a trailer. So say that my accountant says I got to go buy a new truck because I'm out of write-offs on this one. Well, geez, if you need a truck, if you have to have a truck, if it's time to replace your truck, replace your truck. Don't get rid of a perfectly good truck because you're worried about paying a little extra taxes. You might be able to keep that money in your pocket. So depreciation works like this. Let's just say, for round numbers, you're going to buy a truck that costs $75,000. All right. Now, a truck is what we call a 3-year property, which means you depreciate it over 3 years. So we would take that truck and divide it by 3, and that'll give us $25,000 worth of depreciation for 3 years in a row. Okay. Now you can play with this number. There's something called a Section 179 deduction, where you could take the whole thing in 1 year. You could take 50 1 year, and then 12.5 and 12.5. You put the rest on a schedule. You can play with this number a lot. I'm just using this for an easy math example. Okay. So for 3 consecutive years, say you made $100,000, you would be able to take $25,000 off of that, which would leave you $75,000 in income, okay? Now, a truck is a 3-year property, a trailer is a 5-year property. Different things get depreciated on different schedules. I just wanted to show you how that works. And then this would be, it's a tax deduction, again, not a credit. Okay, that's the basics of a depreciation. Now we're going to talk about why we're here. We're going to talk about deductions. So for this example, we're going to, well, first off, let me say a $10,000 deduction. Let's say that you you repainted your truck, a really fancy paint job, right? Really, you got to have a sweet ride, right? Because you got to have write-offs. So a $10,000 paint job is what you spent, okay? That does not save you $10,000 in taxes. A $10,000 well, you could depreciate that because it's considered possibly a large ticket item, but we're going to talk about, well, here, let's Let's reduce that so then we're not talking about so much money, okay? $5,000. Does not save you $5,000 in taxes. $5,000, well here now I just went and made the math hard on myself. 10 would save you $1,500 in taxes. If you say your marginal tax rate is 30%, okay, with state, federal, self-employed, local, it all adds up to 30%. That would be your marginal tax rate. 30% of 5,000 is 1,500, right? I believe it is. So spending 5 would save you 1,500. It didn't really accomplish what you're looking for, did it? You needed the write-offs. You needed to reduce your taxes. You blew it, man. So say somebody says, and people do this all the time with mortgages, you can insert mortgage here instead of truck note. Somebody says, you got to keep your truck note, man. That interest is tax deductible. So if you pay $10K per year in interest on your truck, that would save you $3,000 in taxes, wouldn't it? In a 30% marginal tax bracket. It's disappointing once you know the truth, isn't it? That's the hard numbers behind this bullcrap that people are feeding you. That's, in a nutshell, that's it. It's not much more complicated than that. Yeah, there is some different things that would affect this by a few $100s here and there, but we're just doing round numbers right now, okay? So why don't you send me, and I could put my address in the description here. Send me $10,000 and we'll call it a consultation fee. Make it out to me. Make it out to cash. I'll make it out to me. I'll even give you my name. You could take, I'll give you a receipt. I'll send you a receipt in the mail. And you'll get that saved $3,000 in taxes. I'll pay the tax on that $10,000. I don't have a problem doing that. Does that sound absurd to you? Okay, what about this? Why don't you take your truck and drive it down the road at 90 miles an hour so you get 3 miles a gallon? Because fuel is tax deductible, right? Got to have write-offs. I'm saying this is what they're saying. You got to have write-offs. Why don't you take your truck every week and drive it head first into a bridge abutment so you can fix that son of a gun? You could spend $90,000 fixing that thing because repairs is tax deductible, you know. When you look at it that way, it sounds pretty absurd, doesn't it? You just got to change the scenario a little bit. We ain't going to do any of that, are we? That's just freaking absurd. Let's make better decisions. We'll look into how that we can keep some of this money in our pocket. Now let's go back to $100,000 a year. This is what we got to after we took our, say you grossed $250,000, you deducted your fuel, your insurance, your maintenance, your days on the road. We deducted everything. This is what we're left to pay tax on, okay? So what can we do to get some deductions and keep the money still in our pocket, okay? You may already be a step ahead of me if you've been watching my previous videos. I've been wanting to get to this video for a while because this whole gotta have write-offs things really drives me nuts. We're smarter than that, okay? Before we get into these numbers, I want to say that we're not talking investing here. Okay, we're not talking about what's the best investment in regards to a Roth versus a traditional in any of these. Most of the time a Roth is clearly a better investment. Today we're talking taxes. If you're in your mind so concerned about saving taxes, I'm just showing you how to save taxes. I'm not showing you what is a better investment. Okay, so for all you math nerds out there like me, just slow your roll and let's walk through this. $100,000 a year taxable. We want to reduce that. So if you've seen my previous video on retirement accounts for self-employed people, you'll know that you are eligible for a SEP IRA, solo 401k, something along those lines. And they are both $25,000, or I'm sorry, you can contribute 25% of your income up to $57,000. So 25% of $100,000 is $25,000, right? So you just took and that's tax deductible in a traditional, in the SEP or a traditional Roth, or I'm sorry, a traditional solo 401k. So you just took a $25,000 tax deduction, but you still got the money, don't you? You wrote a check, but you wrote that check to your account, to just a different account. It's still your money. So that's pretty cool so far, isn't it? Well, we're just going to call this right here a SEP, okay? Now, after that, we haven't even talked about this yet. I haven't done a video about this yet, but I'm going to, because people need to, if you're not familiar with this, you need to be. We're talking about an HSA. Okay? An HSA is possibly the most tax advantage plan in the United States. It stands for a health savings account. If you're self-employed, you have your own health plan, chances are it's a high deductible, and chances are it qualifies for an HSA to go with it. A lot of, like if your spouse, you get your insurance through your spouse's job, a lot of those plans qualify for an HSA. You have to check and see if you're qualified for this, okay? And if you are, hey, this is a winner for you. Now, in 2020, the contribution limits for an HSA are $3,550, okay? And if you're married, the contribution limit is $7,100. All right, so we just spent another $3,500 to $7,100 into an account in our name. We kept the money, and we didn't spend it foolishly on needless things. And we reduced our tax bill another dollar amount, this dollar amount here. Okay. Now, the next thing you can do, and this is another thing here. Well, first let me say, this HSA, you don't have to spend the money. It's for health-related expenses up till retirement age, and then after that you got some more versatility. But you don't ever have to spend the money. You can let that money accrue and roll over. You can invest it in different things, okay? This next thing, you have to spend the money every year. It's an FSA. This is a flex spending account. The limit for 2020 is $2,750. All right. Now, like I said, you have to spend this money, but by the time you figure, it sounds like a lot, but if you go to the chiropractor, you go to the eye doctor for your annual, get new glasses, you go to the dentist, maybe have a couple fillings, this doesn't take long to get close to that, okay? If you don't think you're going to spend that much by the end of the year, don't put that much in. You could put $500 in here, okay? That's a pre-tax contribution that allows you to take that money then and spend it on medically related items. I use it for my eyeglasses every year. Eye doctor, dentist, chiropractor, things like that. So, once again, you kept that money. Well, technically you're going to spend it, but then you're allowed to spend it tax-free. Okay? The next thing, well, first before I continue, let me just say, if you're the type of person that says, well, I ain't doing any of these things, I ain't putting my money in the stock market, that's freaking crazy, you'll lose it all. Well, let me just say, this is just the type of account. You can put the money inside of this account in whatever you choose to, within reason. And one thing you can do with it, if you're worried about that, is you can leave the money in cash. You can let it sit there in the cash balance and never invest it. It's totally up to you if you will choose to do that. I just wanted to mention that because I don't want you to be dissuaded from doing it because you think you don't want to put that money at risk. Hell, if you're the type of person, you can invest in gold inside of some of these things, okay? If you're a gold bugger, the world is your oyster. I just want you to know that. And some of these things, we're not going to necessarily take on the business Schedule C. Okay, they're going to go on your personal return. I'm just listing them here for demonstration purposes. Like the next thing, the IRA, that's definitely coming off your personal return, not your Schedule C. We're just doing numbers here, okay? Let's not be critical of that part. It's all going to work out the same in the end. So the next thing is IRA, right? And we know from my previous video about retirement accounts for self-employed people that if you're under age 50, you can put $6,000 a year in. If you're over age 50, you can put $7,000 a year in. Now, if you're married, double that, okay? If your spouse does not work outside the home, they help you in the business a little bit, and that's just what they do, spousal IRA for them. Otherwise, if they earn an income, they're entitled to their own IRA. This is the part where a Roth IRA would be better, but like I said, we're just talking about taxes here, not investing, so definitely work that out for yourself. The same up here with the solo, you could do a Roth. We already talked about that. I'll move on from that. So now depending on here, we took all these deductions, and depending if you have a spouse or not, okay, we're going to land somewhere $51,000 to $63,000. We'll average that out. We'll call it $57,000. I'm just trying to figure if you have a spouse or not, okay? We don't have to be done yet. If you watch that video on retirement for self-employed people, there is a possibility, if your spouse does not have a job outside the home, if they work in the business, if they draw a salary, they can have their own SEP or solo 401k or a spousal one. It's part of the business. So you could contribute additional money to that, okay? We won't worry about that for now because you already reduced your taxable. You dropped yourself a full tax bracket. In addition to the tax savings, you dropped yourself from the 24% federal tax bracket to the 22% federal tax bracket, okay? You might be happy to stop there. That's a pretty reasonable tax bracket. You'd have to spend an awful lot of money to get to the next tax bracket. Plus you need money to live on. So $57,000, that's more than $1,000 a week. $57,000 and we're going to pay taxes on now. Let's just back up here for 1 second to the previous board, because some of you guys are pretty sharp and you'll call me out on this if I don't point it out. The $25,000 for the SEP that we took a deduction on. Now, a SEP does not reduce your self-employment tax, okay? So instead of like a $25,000 deduction, maybe you'd want to just consider that like a 20 or 18 or 19. We're just using round numbers here, proof of concept. We're not nitpicking, okay? I'm just trying to show you what's possible. But I just wanted to back up and say that so that I'm clear on that. Maybe you're happy to stop there. I don't know. It's up to you, because you need money to live on. You got to survive, right? You got to eat and pay your bills. But at this point, we did most of what we could to keep that money in our pocket and still take some deductions. Now, some additional strategies we can employ is to pre-buy some things. It's perfectly legitimate, especially if you're on cash accounting. If you're on accrual, then you got to account for them differently. But we're talking small business here. Me and you, 1 truck, 2, 3, 4, 5 truck operations, are most likely on cash accounting. And if you don't know what it means, it really doesn't matter at this point. What if you need, in 6 months, you know you're going to need a set of drive tires? Well, buy it before the end of the year if you're concerned about taxes for the year, and then you'd be another $4K, $53,000, right? Maybe you could use some fluids, buy a few cases of oil, grease, washer fluid, antifreeze. You could easily spend another $1,000 doing that. We're still buying things we need. We're still not to the point where we're buying flippant things to save tax money, right? This is all just demonstration of concept, okay? We're using round numbers, quick and dirty math, but it's not that far from the truth. Continue down this road. You can go, but you may say, okay, well, I'm just creating a problem for next year. I'm buying all these things, tires and things that I don't need, and next year I'm going to have all this extra income. Well, you could do it again next year. And you might say, well, I'm just kicking the can down the road and creating a tax problem in the future. Well, eventually you're going to have an overhaul, or you're going to get a new truck, or you're going to get a new trailer. And then at that point, you can use that purchase to offset the money that you were kicking the can down the street, okay? Or you might encounter even next year, another year like this year, where everything sucked and most of our incomes were down drastically. Well, then maybe that's a good year to account for some of this extra money, okay? We can worry about next year when it comes, but it doesn't say we should completely ignore it. You should always keep that in our mind and plan it with your tax person. But there's just so many strategies we can do here to not have to spend money foolishly. And I know I'm passionate about it, but you know, to see so many people struggle and to find out that they're doing things like that, maybe it's not their fault. Maybe they were given bad advice, but it's just not necessary. So hopefully I can change a little bit the way you think about things here. And if you like this kind of thing, hit that like button, subscribe, and we will see you next video.